Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 29th of May. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about the rare phenomena of corporate bond spread tightening, while default rate is on the way higher as well. Today, we'll focus upon another apparent paradox, that the US dollar has been moving in the same direction as global growth, while typically it moves in the opposite direction. Now, the US economy is indeed more highly geared towards services than manufacturing versus the rest of the world. So therefore, when global growth reaccelerates, capital typically flows from the US to the rest of the world, increasing the demand for foreign currencies and decreasing demand for the US dollar. But this relationship has not been holding so far this year. The revival in the global manufacturing cycle and this year's global equity gains have both occurred alongside US dollar strength. So what is happening here? Well, one explanation is that the US has been a major driver of the global growth revival, while Chinese demand remains lackluster, given domestic deflationary forces and underwhelming stimulus efforts. Another thought lies in the interest rate differentials, which have been supportive of the US dollar versus other currencies. Now, persistent price pressures have delayed Fed rate cuts, while other major central banks have embarked or are on the way to do a dovish pivot. However, with US bond yields starting to fall as inflation began to soften once again in April, we believe inflation expectations and bond yields are likely to drop at a gradual pace, effectively putting a cap to US dollar gains. Moreover, growth has started to rotate outside the US, which could pressurize the US dollar over the near term. Technically, the DXY index, or the US dollar index, has entered bearish territory under MACD, and the ADX index is pointing towards near-term pullback in the US dollar as well. Support level for the DXY index lies at 103.90 and 102.40. Now, incidentally, it is interesting to note that the DXY index hit its year-to-date peak in the middle of April, when the Hang Seng index started to ratchet from the 16,000 level all the way up, getting close to the 20,000 level. Now, there has been fund rotation from US risky assets into assets elsewhere in the globe. And again, we would like to highlight the tactical opportunities in Hong Kong China equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.